Good afternoon, everyone. Thank you very much for staying with us, and I feel very honored. I'm Casey from Wind, and pleasant to host and moderate today's highly anticipated topic about evaluating the investment opportunity and unlock the investment opportunity in China. So we have seen a great representation and composition of today's panel because each of us represent different angles and the lenses from the table. So Zoe has more than 10 years of experience and research expertise in international policies related to financial market as well as economy, and her recent focus is on China, Japan, and GCC region. And Ethan founded RT Capital, which is a PE firm, has long relationship working with Abu Dhabi to promote the connectivity and the investment opportunity between the region and China. And myself, Wind, for people who are not familiar with Wind, we are the Asian leading financial information and technology solution provider, and we have broad experience, over 30 years of experience consolidating information on the financial markets of different asset classes, macroeconomic information globally, industry information, private market, as well as the company level information. So without further ado, I think let's delve into today's topic. I want to start, given how extensive your experience is, I want to start with observations and trends. So we've seen ample topics, discussions at the very high level about to promote the cross-border economy, trade, investment opportunities between the MENA region and China. And based on your past experience and observations over the past, what trends did you see over the past 4 months? Maybe let's start with Zoe.
Sure. I know, it's truly a great honor to be here. And to directly answer your question, Casey, one important aspect that I wanted to point out today is that the interdependencies between East Asia, not just China, but China, Japan, and South Korea, and the MENA region, in particular, the Gulf Cooperation Council members, are actually go beyond hydrocarbon. And today, or 5 years ago, people have been talking about China is going to become the largest energy importer from the region, and guess what? As of last year, China has maintained its position as the largest oil importer from Saudi Arabia. Latest development is that both the central banks of the PBOC and the Saudi Central Bank signed a currency swap agreement in the amount of about $6.9 billion, which is about 1/10 of China and the Saudi's oil deal last year. And you are going to see this in terms of the use of renminbi in energy pricing, not just in oil, but also in natural gas and perhaps in critical minerals. And then the second point with regard to interdependencies going forward is also in the context of renewables. And that speaks to not just electric vehicles, but in many ways in terms of nuclear energy as well. The very first deal that UAE has made in terms of developing their nuclear energy sector is actually made with South Korea. And literally a few days ago, UAE signed, a few months ago, UAE signed nuclear energy deals with the Chinese nuclear energy operator. So from that perspective, what we are going to observe going forward is the use of renminbi in commodities trading between the two regions and deals beyond hydrocarbon, and in particular in renewables.
Yeah, thank you for sharing with us the latest economic and policy developments. And Ethan, why don't you tell us some of your front row experience from investment? What did you see over the past year?
Yeah, from our experience, from our observations, after the lockdown in China finished earlier this year, we received a lot of requests from Chinese companies. They are very interested in exploring the investment opportunities in Middle East. And they are very interested in the business potential, environment, and capital in the region. In May this year, we actually arranged a tour from Hong Kong and China, arranged 20 business leaders to come to Abu Dhabi and Saudi Arabia. And actually, some of them already confirmed to expand their business into Middle East. From investment and capital flows side, the value of acquisitions and investment by Gulf funds into Asia country has climbed to $2.3 billion this year. It doesn't include the capital flows from passive and private investments. There are several iconic deals, such as an Abu Dhabi sovereign funds investing investing near $1 billion into a China EV automaker's NIO. Mubadala confirmed an investment into a Chinese life science real estate for $100 million a month ago. I guess except for the investment capital from Middle East to China, we do see a lot of interest from Chinese companies to invest into Middle East and expand their business in the region and using Abu Dhabi as the hub.
Great, thanks for sharing the perspective. Indeed, I think before there's capital flow, there is always business flow first, right? So myself, I took 3 trips over the past 2 months to the region to really feel on the ground. So these are all very encouraging points and news to hear. I think that said, if we look at historical statistics, around 90% of the capital flow in the MENA region actually was deployed in North America, European region, rather than Greater China. So from your experience and your consideration, what could be the possible hurdles or considerations that people were seeing in the past, if there was any, to prevent a higher than expected capital inflow into China? So put in other words, what could be the possible catalyst in the future if we want to unlock these investment opportunities in China?
Yeah, I'll get us started.
I can share a little bit. It has a very technical reason why those capital flows, they invest into different markets instead of China. When we look into the MSCI World Index, this is the benchmark for the worldly benchmark index, and U.S. companies account for 70% of this index. Japan, UK, France, and Canada are near 20% of this index. Hong Kong has a very small percentage, while China not even in this index. The huge AUM benchmark, this MSCI index is close to 15 trillion US dollars. However, China is the second largest economy in the world. It's only placed as the MSCI emerging market index, but not the world index. So although China accounts for 30% of this index, and the AUM of this index is sizable at 1.3 trillion US dollar, is indeed less than 10% of the MSCI index AUM. Therefore, the capital which use the benchmark index can only invest a very small percentage of their capital into China. This is the technical reasons I mentioned why the global funds invest mostly into other markets instead of China.
I guess, even you are right in terms of all the technicalities. But if I can just summarize what you described, one important reason, at least historically, why foreign direct investment into China has been a very important hurdle would be capital control, and this becomes particularly challenging in light of recent news, especially the Chinese economy fails to recover or snap back as expected. And then on top of that, obviously, the geopolitical tensions between the United States and China does not help at all. It used to be the case that CFIUS in Washington, D.C., the panel of U.S. government from different agencies chaired by the Treasury Department, used to be the case that they care a lot about foreign direct investment into the United States, especially from Chinese government-owned entities. But now, earlier literally a few months ago, President Biden signed an executive order with regard to outbound investment screening regime, specifically targeting American capital that can potentially enable science and technology R&D in either sponsored by Chinese investors or in mainland China. So from that perspective, that geopolitical tensions is going to continue sort of sour deals. That's the unfortunate news. And remember, everybody, next year is going to be an election year, and that is not a good news for capital flows to begin with. And then finally, I'll just conclude by saying that historically, as Casey, you mentioned earlier, historically, the Chinese market even today, the Chinese market has never been perfect. And no foreign investors even said that they are perfectly happy with the Chinese market. However, cross-border capital flows, they do prefer policy predictability. Leaders come and go, CEOs come and go, but the policy environment has been stable inside of the Chinese market. However, that has gone in the past few years. Now, President Xi Jinping recently visited Shanghai in the hope of revitalizing Deng Xiaoping style southern tour, to what extent that he can use the opportunity to stabilize, or more importantly, inject confidence in the Chinese economy. That is very much unknown. Now, in his dinner at APEC with American CEOs, he could have had the opportunity to sort of send out a positive information focusing on the CEO group. But from my conversation with people who attended the dinner, it turned out that people felt that he fell short to reboost the confidence. So perhaps going forward, we'll see more policy bazookas, hopefully, but so far there is no policy bazooka. We'll see what is coming.
Yeah, so there is a complex set of reasons, different considerations behind. There is geopolitical reasons, policy. There is also index, which creates vibrant exposure to the market. And I think based on my past role as Goldman Sachs investment bankers, I used to facilitate hundreds of global investors to visit and meet Chinese companies and Chinese entrepreneurs. And one of the common themes that I have heard from them is they feel there is a natural disadvantage for these key decision makers of global investors to sit outside of mainland China. So they have a limited access to, and they don't even know where to find the source of information, even those information exists somewhere. So there is kind of like the limitation of information, transparency, and trust and relationships, so all of these kinds. So that's why also for us, we feel there is a natural obligation and responsibility for Wing to be here in the region and be global. So very important for us to build the information investment infrastructure. And sometimes I heard the earlier panel talking about educating investors globally on where and how the best approach to look at insightful information about China opportunity. So I think looking forward, looking ahead into the future, what are the investment opportunities that you think lies in China in the next 1 to 2 years? Could that be in different asset classes like public and private equities, debt, or the passive index, the passive investment vehicles, or in what other segments that you see? I think maybe start with Zoe.
Sure. I think index investment is always relatively easy, and you don't have to pay your lawyers in terms of advisory fees, especially given the executive order in terms of outbound investment screening that specifically is targeting the private equity deals, right? But I would say sector-wise, you would want to look at the sectors that are most geopolitically resilient. And from my conversation with American business leaders as well as business entrepreneurs in China, there are 3 sectors that are particularly interesting, which is food security, climate change, and healthcare and aging. And these 3 sectors are the cutting-edge theme connecting United States, China, and the Middle East. And it doesn't matter who comes, which president comes out, but hopefully not Donald Trump, but those 3 sectors is going to be geopolitically resilient.
Okay.
Ethan?
Yeah, from our perspective, we see a very good investment opportunity in the NEV, the new energy vehicle sectors. We expect, first of all, we expect the global penetration rate will jump to 50% from current below 20% in 2030. Secondly, we see that last year, in 2022, the EV penetration rate in China is reached 28% versus the global penetration rate of 15%, as mentioned. We expect the China EV penetration rate to continue its lead. Where there will be ample investment opportunities globally, we expect EV sales will go over 30 million units every year, or can generate more than 2 trillion of revenue. Among the global automakers, China EV makers have been at the forefront of developing EVs and related technologies, striving to deliver the best value proposition to consumers. We are now beginning to see the hard work of the China EV makers pay off. Actually, the export demand for Chinese cars have accelerated by 2.8 times over the last 3 years. And China has even overtaken both Japan and Germany to become the top one opto exporting country in the first half this year, demonstrating how competitive Chinese vehicles are in the global market. Within the China EV market sectors, we expect these trends create new opportunities in automotive technologies, particularly the ADAS system, which we like, and also the Chinese companies are leading in the world. We are also fond of the technology related of smart cockpits, battery management system, as automakers use those consumer-facing technologies to help differentiation and also enhance overall customer experience. As a leading investment house, Arctic Capital has an EV fund investing into this segment, into the EV supply chain. And we expect that it can generate very handsome return with manageable risk.
Well, thank you so much for sharing your great minds. I think it's all about balancing the upside, the growth of these sectors, as well as you said, the resilience of the sector, managing the risk well. And I think the audience probably have taken down some notes when they formulate their investment strategy. So thank you very much for being with us today. And I hope if you have any questions about the ideas, welcome to join us in some offline discussions. Thank you for your time. Thank you.
Thank you.